Scott Riley with the Market Update Desk and a not so scary Friday, September 29th. Welcome to the end of the week. We got great news, even better than what we had forecasted on personal consumption expenditure report today. That's PCE. That's one of the Fed's favorite measures of inflation. So, headline PCE, which we were concerned about, actually came in at 0.4% up versus the expected 0.6%. And we were actually concerned about potentially getting a 0.6%. So that is great news. The bond market really enjoyed that less than expected inflation news. That did bring us year over year up from 3.4% to 3.6%, but once again, better than forecasted. Now, the all important core CPI, which strips out the volatile food and energy, specifically oil, because that's been on a tear lately, that went up 0.1%, actually the lowest month over month reading in a long time. The expected was 0.3%. So we have awesome news on that. That brought us year over year under 4% to what's called a three handle, got us to 3.9% year over year. What did that do? Move the bond market to the better and mortgage-backed securities better this morning. So we got a decent little improvement on pricing for mortgage rates. Thank goodness. I can actually tell you something that is good news, and we are thankful for that. When we do a little bit of deeper dive into the core, and what the Fed is really looking for is to get to 2% inflation. We've been saying it every month, every week. The Fed keeps hammering on that. If we look at a 6-month average of core CPI, we're actually at a 2.9% rate for the last 6 months. In fact, the last 3 months, we are sitting at 2.4%. So we're this close to getting a current real number of 2%. Let's hope that the Fed pays real close attention to the trend line and the lag in information. Specifically, the lag we've been talking about is housing expense. That's shelter costs, which is starting to benefit us a great deal now. Within the report, we saw consumer spending actually increase slightly to 0.4% up month over month. Conversely, though, we saw consumer savings drop by 0.3% month over month, and we're now at the lowest rate of the year of personal savings, 3.9%. This is a significant concern. As personal savings goes down, disposable income goes down, and the ability to spend on goods and services goes down. We are seeing the potential for a third quarter GDP slightly lower than expected because of the UAW strike. So there's a lot to play out with that. If we do see a revision lower, that has the potential for helping the bond market and mortgage rates. So we're going to see how all those things play. It's very pleasurable to come in and report positive news. It's been a real tough last 4 to 5 weeks in the mortgage world, but we are trending in the right direction. Next week, we have very important data coming out. Wednesday, we have the JOLTS report, job opening and labor turnover, and the all-important Bureau of Labor and Statistics report on Friday. So we're hoping we have some great news for you next week. We're open and working on weekend. We can help our buyers get pre-approved, work on getting offers accepted. We've been having great success at that. Give us a call. We're always available. 616-293-2189. The whole Market Update Desk team is here to help you out. Give us a call. We look forward to it. Have a fantastic weekend.